Welcome, everybody, to today's presentation. My name is Bill Rossitto. I'm one of the financial consultants here at Alliant Retirement Investment Services. Now, before we get started, it's important to acknowledge that there's no single perfect planning strategy. Every option comes with its own advantages and limitations, and no one approach is going to work for everybody. Here at Alliant Retirement Investment Services, or we like to say ARIS, we understand that everybody's situation is unique and different. In this presentation, we're going to share key insights to help you make informed decisions about planning and saving for college, retirement, or frankly anything else you want to plan for. Our team at Alliant Retirement Investment Services is focused on helping you understand the ins and outs of investing, saving for retirement, and so much more. A great place to start is at our website, ARIS, that's ARIS.AlliantCreditUnion.com. There you'll see a list of our weekly webinars, our podcast, Invest Savvy, our blog, as well as other financial resources and all of our bios as well. We help most of our clients by planning for long-term events. Long-term events is anything beyond 18 months. Why 18 months? Because once you go beyond 18 months, you're starting to compete with the long-term effects of money. Inflation. Inflation is the rate at which prices go up over time. Gas, food, housing. We've been getting a crash course in that in the last few years. Well, what we do here is we help you plan for the major events and get you there as quickly as possible while limiting your taxes, your risk, and your fees. Today, I'm going to talk to you about how you can work towards achieving your various financial goals, whether they be retirement, college savings, or anything else, while still managing your debt, emergency reserves, and competing priorities. Now, before you can save and achieve all your financial goals, you have to have money to put away to do so. So I encourage everyone to try to live off of 70 to 80% of your income to create some capacity to save. Now, I get that this may mean making some small sacrifices, especially in the short term, to free up money to put towards other goals. However, we also have budget worksheets at Alliant that we can kind of share with you that give you an idea of where you are seeing your money go, just to put up a financial mirror to see this is where your money's going so that you can be the boss of your money instead of your money being the boss of you. So when you are starting to goal, the first thing you got to do is define the goal. You want to see what it is you're saving for and then determine when you're going to want to need it. So if it's 5-10 years down the road, then you have to consider how much it's going to cost, not today, but at the time you're going to want to buy it. Once you define the goal, now it's time to make a plan on how to achieve it. So you want to know how much to save, the entire amount, a portion, a down payment. Obviously, this is going to depend on your goal. Next, you want to do is figure out which account makes the most sense for the goal. There are different advantages for different account types, which I'm going to get to in a second. You also want to use an appropriate investment strategy for the goal. You got to invest appropriately for the timeline and diversify. Now, as I just alluded on the screen before, there are different advantages for different types of accounts. Regarding retirement and college savings specifically, there are potential tax benefits that exist when you're saving in certain qualified accounts. Now, I don't know too many people who want to work into their 90s, so almost everybody can agree that the number one savings goal that most people are going to have is retirement. Now, there are two simple factors that can help you answer the question of how much is enough: your age and your salary. In order to retire and maintain the same lifestyle that you currently have, I believe you should aim to save the specified multiples of your current salary by your respective ages. So the savings target shown here assume that retirement age is going to be 65. They also assume that most retirement savers should plan to replace about 75% of your pre-retirement income to maintain your lifestyle during a 30 some odd year retirement. So I get that those numbers may look intimidating, especially in those later years. But remember, compounding is your friend and it's working for you. So it's important to focus on saving early and often. You should try to save at least 15% of your salary each year for retirement. Now, that doesn't all have to come from you. Some of it can come from your company contributions and things like that. If your budget doesn't allow for that, well, then save what you can now. I suggest at least 6% and then increase your contributions by 2% or more each year. Over time, you're going to get up to that 15% target savings rate, and you're going to feel a lot more confident about your progress towards your retirement vision. The best way to manage risk is to understand the concept of asset allocation. Asset allocation is investing your money in spreading it out and diversifying into different investments. Now, the more risk you take, like say in stocks, you're going to earn a lot more money over time, but it's also going to fluctuate a lot more. So you need time to make up for that risk. Whereas shorter term assets like bonds and, well, short-term assets like checking accounts and CDs and things like that, they have less risk, but they may not necessarily beat inflation over time. So you need to balance this out. Now, most of us invest within our 401ks or 403bs or retirement accounts in mutual funds. And in those different types of accounts, you're going to have two different ways to invest. Age-based investments, you may have heard of target funds. Those are age-based investments where it'll have a target date. Now, the further that target date is, the more aggressive that fund will be. As it gets closer to that date, it'll automatically pull back on the risk to be more in bonds and less risky investments. The other type is if you want a little bit more control over your investments, you can build your own portfolio and pick your own mutual funds yourselves. Now, this gives you more control, but it also gives you more responsibility because now you're responsible for balancing it out, and periodically, usually every quarter or so, you should go in and rebalance and make sure that it's performing the way you want it to. Everybody needs emergency savings or a cash reserve account. Trust me, you do not want to be the one who their car breaks down or you have a short-term need at home and you have to pull out your credit card without having the money to back it up, or worse yet, have to liquidate your 401k to take care of a short-term need. That is a super, super expensive way to fund a short-term need. Okay, so how much cash is enough to keep in a cash reserve? Well, I suggest saving between 3 to 6 months of living expenses in cash at all times as a cash reserve. Now, that's how much you spend, not how much you make. So if you spend $5,000 a month, you probably want to keep between $15,000 and $30,000 in cash at all times. If it's less, well, you may need a little less. If it's more, if it's $10,000 a month, you may want to keep between $30,000 and $60,000. But the right number is up to you. If you have no idea how much your expenses are, well, you may want to consider setting a goal of 15 to 20% of your income would be a good target to start with. College savings is often top of mind for a lot of parents. I get it. I have 3 in college right now. I have 1 in New York, 1 in California, and 1 in Nevada. So I understand how important it is to save. However, when it comes to saving for a child's education, I encourage parents to continue saving towards retirement and only consider reducing your retirement contributions to fund a college account if your retirement is already on track. When I talk about being on track, I'm going to go back to that chart I showed you earlier with the X times salary figures dependent on your age. If you're not on track for retirement, you really could end up jeopardizing your future by stopping to save for a college education. Now, if you're already positioned well to save for education, great. I encourage you to set aside a savings goal of a kind of a down payment, which is a target of saving approximately 50% of your child's education costs. There are all sorts of calculators online that can help you figure this out, and frankly, we can help you with this as well. So once you decide that you want to start saving for college, there's a couple of different ways to do it. You can do it in a regular taxable account where you contribute money to the account. You invest in whatever you want. Your options are endless. Now, you're likely to pay taxes on any earnings along the way via 1099, and then you're also going to pay taxes on any other earnings when you pull it out via capital gains. Then you get to spend whatever's left over after paying your taxes. There are other tax advantage accounts as well, though, that you can contribute to, the most popular of which being a 529, where you invest in something, typically it's mutual funds. You pay no taxes on any earnings when you withdraw, as long as you spend the money on qualified education expenses. And then you get to spend the entire balance since you don't pay any taxes on any of the earnings. Also, as an extra added bonus, many states offer additional tax benefits for contributions to a 529 plan as well. So either check it out with your local state or ask one of us for advice on it. Now, switching gears a little bit, managing debt is a common goal that I hear about all the time. Often debt prevents people from being able to save for retirement or achieve the other different financial goals you have. Now, debt itself is not necessarily a bad thing. It just needs to be managed. I have a saying that I say, there's good debt and bad debt. Good debt are debt that earns equity over time, like a mortgage, or if you're, funding a business or something like that. Bad debt is credit card debt. It's super expensive. Now, I'm not saying credit cards are bad. Credit cards are fine. I use them all the time. You get the miles, all that great stuff. But when that bill comes at the end of the month, you have to pay it off because otherwise it's very expensive money. When it comes to paying off debt, you want to target high interest credit card debt first and work hard to pay that off as quickly as possible. Understand that, you may not be able to pay off all your credit card debt in a month or two, but I really encourage you to make a plan to try and pay off credit card debt or any high interest debt within 1 to 3 years. Now, there are a couple approaches on how best to tackle debt. The first school of thought is the behavioral approach. That's where a person tackles the lowest balances first and works hard to pay them off while continuing to make payments on all the other cards. Once the smallest card is eliminated, then you take all the amount that you were paying towards the smallest card and you take that and add it to your next highest balance. What this does is this creates a little momentum where you see the progress you're making of paying off your bills. Now, the economic approach is when a person targets the highest interest rate card first and then accelerates payments. Again, once that highest card is paid off, then you reallocate the payment to the next highest interest rate. It's kind of plugging the biggest leak approach. Now, as you're working to pay off the high interest debt, you want to keep making regular payments on other kinds of debt. Don't stop paying your student loans or mortgages to pay off your credit card debt. Once the debt is eliminated, now what you want to do is start working to get your retirement savings back up to that 15% target. All right, well, now that we've talked about some financial goals that you have and how to go about achieving them, now I want to talk about prioritizing between them all. Now, I get it. We have all these great goals, but we only have one paycheck. How do you prioritize one of the over the other? I'm going to give you this chart to kind of help you figure it out a little bit, how best to prioritize. When it comes to choosing between retirement and an emergency fund, consider reducing your retirement savings to the minimum. Now, you don't want to go below. You want to still maximize your company match. You don't want to throw away free money. But once your emergency reserve, over the next 1 to 2 years or so, once that gets up to a certain amount, then you can consider increasing the retirement savings back up towards that 15% target mark. If you're trying to figure out between retirement and debt, again, maybe reducing your retirement savings to the minimum. Don't give up that free money from your company, and then pay down the credit card debt within 3 years, and then you can get that savings back up to, again, 15%. If it's between having a cash reserve and debt, well, consider reducing your retirement savings, again, to the minimum. Build up your emergency reserves over the next 1 to 2 years, and then pay down that credit card debt within 3 years. Try to do it. And then again, you can kind of go back up into saving back up to a normal load. What you need to do is you have to have that cash reserve in there, because you don't want to have to dip into that credit card and build it up again. So you need to have a cash reserve in place. When it comes to retirement and college savings, confirm that you're on track for retirement first. If you're close to the recommended benchmarks, then you can reduce your retirement savings temporarily and contribute towards that college down payment. Hopefully you've gotten today some clear ideas that you can take action on. Just know that you're not alone. We're here to help you. Whether or not you're trying to figure out when's the best time to take Social Security, should you take it early or should you hold on and wait later? Or whether or not you should convert your traditional IRA or 401k to a Roth. And if you decide to convert to a Roth, well, how do you avoid the tax pitfalls that can happen if you're not careful? Or if you're looking for new ways to invest your money, get your money earning more, or if you've had a new job or a major life event like a wedding or a birth, or if you already have everything else set and you just want to do some generational planning, making sure your estate's in order. We're here to help. Ultimately, our job is to help guide you to your goals with a tailored plan that can meet your needs and timeline. So on that note, why not feel free to reach out? If you want to make an appointment, feel free to scan the QR code here. It'll get you to my calendar where you can schedule a time to talk. It doesn't cost anything to talk or ask questions or even make a plan. Or if you have a question, another way is you can dial me directly, or you can reach out via email. Either way, thank you for your time, and I look forward to seeing you all soon.